Dive, your daily source for focused financial insights. It's Friday, August 15th, 2025, and we're cutting through the noise today to bring you the core intelligence from yesterday's brief. That's Thursday, August 14th. Today, we're unpacking, well, a fascinating tug-of-war in the U.S. economy, global market divergences, and, what it all means for where your capital might be heading. Let's start right where the brief begins, U.S. inflation and the labor market. Because the data we saw yesterday, it presented some really interesting, maybe even conflicting signals. U.S. producer prices, which give us a sense of input costs for businesses, rose a hotter than expected 3.3% year over year in July. Yet weekly jobless claims, a key gauge of labor market health, actually fell to a pretty low 224,000. So for our listeners who are tracking these nuances, what's the long-term implication of this specific tug-of-war between rising producer prices and a still resilient labor market? Does this data point toward a higher-for-longer rate environment more strongly, or is there still a path to maybe aggressive cuts from the Federal Reserve?
Yeah, that's the million-dollar question, isn't it? While many in the market might be holding out for significant rate cuts, seeing both producer prices rise and jobless claims fall, well, it tells us the economy still has significant momentum. This might give the Fed, less urgency to ease monetary policy, could potentially keep borrowing costs elevated for longer. So for you, the listener, this means a few things. Businesses might face continued margin pressure from higher input costs, which could eventually trickle down to consumer prices, even if a full-blown recession is avoided. It's a delicate balancing act the Fed is navigating right now, trying to cool inflation without freezing growth.
And how did the market react to this complex picture? We saw Treasury yields slip, but the brief also mentions a caution about rate cuts. What's the takeaway there?
Precisely. Treasury yields actually slipped 3 to 5 basis points from the prior session. The benchmark 10-year U.S. yield was around 4.24% as of August 13th. Now, when bond yields fall despite hotter inflation data, it often reflects investors betting on potential future economic softness or, like the brief notes, a certain caution. It suggests the market is perhaps still pricing in some eventual Fed easing, but with the understanding that the path to those cuts might be longer, more drawn out than initially hoped. This creates that tug-of-war tension we talked about, optimism for a soft landing where inflation cools without a recession versus the persistent risk that inflation stays stubbornly high, forcing the Fed's hand.
That's a crucial distinction. It really highlights the depth of intelligence needed in today's markets, the challenge of filtering out the noise to find what truly matters. And speaking of tailored intelligence aligned to your exact priorities, our partner, NextSight, specializes in exactly this. Their platform, built using its open-source OSINT platform SiteConnect, supports investigators, analysts, and decision-makers worldwide with deep, actionable intelligence. It's about getting precisely what you need when you need it. To learn more, you can visit www.next-site.com. All right, let's unpack this with some broader market movements, because yesterday, Equities showed a fascinating divergence across regions. It certainly wasn't a one-size-fits-all day. Walk us through this mosaic.
Absolutely. What's fascinating here is how different regions really reacted to their own, underlying narratives and economic signals. In the U.S., stocks edged higher. The S&P 500 gained about 0.3%, hitting a fresh record at 6,468.54, and the Nasdaq also climbed 0.3%. This rally was largely driven by investors piling into mega-cap tech stocks, particularly ahead of upcoming earnings reports from some major chip companies.
That's an interesting dynamic. How exactly does an AI-led tech rally manage to offset concerns about that hotter-than-expected producer price index data we just discussed? Are these companies somehow immune, or is it a different kind of investor calculus at play?
Oh, that's a great question, and it speaks to investor psychology right now. It highlights how investors are still chasing growth and innovation, even amid broader economic headwinds. Tech companies, especially those benefiting from the AI boom, are often perceived as having strong pricing power, robust future earnings potential, regardless of immediate input cost pressures. So this makes them somewhat less sensitive to the inflation fears hitting other sectors, sort of a relative safe haven for capital, helping pull up the broader index. But in stark contrast, Japan's Nikkei 225 sank approximately 1.4%. This was mostly due to profit-taking after its recent strong rally, almost as if investors decided, time to take some chips off the table after such a run. Though, to be clear, the index is still near record highs, so it's more of a strategic pause than a full retreat. Europe, on the other hand, saw a surprisingly strong rally. The StoxX 600 gained 0.6%, closing at a 2-month high, and the FTSE 100 added 0.1%. This European uplift was fueled by robust earnings from major insurers like Admiral and Aviva, alongside a surge in defense stocks, likely reacting to ongoing geopolitical tensions. Over in Asia, Chinese shares, including the Shanghai Composite and Hang Seng, they retreated by about 0.5% each. Property sector concerns continue to cast a long shadow there, weighing heavily on investor sentiment. However, India's Nifty 50 and Sensex managed small gains around 0.05% and 0.07% respectively just before their Independence Day holiday today, August 15th. So yeah, a truly mixed bag across the globe, indicating that regional narratives are indeed playing out very differently.
A very mixed bag indeed, highlighting how different regional stories are playing out. And if we're seeing this kind of divergence in stocks, are credit markets telling a similar story? Or is there maybe a more unified trend emerging there? Because the brief mentions a significant tightening of credit spreads.
Right. And if we connect this to the bigger picture, tightening credit spreads generally reflect an increased appetite for risk among investors. The ICE BOFA U.S. High Yield Option Adjusted Spread, or OAS, narrowed to 2.89% yesterday. Think of OAS as the extra yield investors demand to hold riskier corporate bonds compared to super safe government debt. When it narrows like this, it signals investors are feeling confident enough to accept less compensation for taking on that credit risk. We also saw single B spreads, which are bonds even further down the credit ladder, slip to 3.07%, and investment grade spreads compress further to 0.97%. So all this points to a widespread increase in risk appetite across the credit markets. And complementing this, the VIX volatility index, often called the market's fear gauge, eased to 14.83. This signifies a noticeable level of market complacency, maybe. This overall environment with moderate default expectations and the view that monetary policy is nearing its peak, while it continues to fuel investor appetite for carry trades, where you borrow at low rates and invest in higher yielding assets. It's a classic move when confidence is high and yields are still attractive.
Okay, so from the relative calm of credit markets to the sometimes chaotic world of commodities, yesterday brought mixed signals here too. What stood out? And more importantly, what were the underlying drivers?
Indeed. In the energy space, oil prices saw a notable climb. Brent crude settled at $66.84 a barrel, up 1.8%, and WTI gained 2.1% to $63.96 a barrel. The key driver cited for this surge was renewed hopes for a potential meeting between U.S. President Trump and Russian President Putin. The market seems to be betting this could spur some geopolitical détente, maybe reducing supply risks. It's worth noting, AFRI data through August 11th showed WTI and Brent spot prices near $65, $67 per barrel, highlighting a slight lag between the forward-looking futures contracts and reported cash market prices. On the flip side, gold slipped 0.5% to $3,337 per ounce. This was largely weighed down by a stronger U.S. dollar and the rising yields we discussed earlier. Those tend to make non-yielding assets like gold less attractive when bonds offer a better return. Natural gas, specifically the Henry Hub spot price, edged up to $3.05 per MMBtu as of August 11th data. Yes. Million British thermal units. It's a common measure for natural gas. And this modest rise was primarily driven by the persistent heat-driven demand in the U.S. as folks, crank up the AC.
Got it. Okay, let's turn to crypto, a segment that seems to be celebrating the most, with Bitcoin and Ether hitting new cycle highs, apparently fueled by Fed cut hose. Now, while the exuberance is clear, are these new highs truly sustainable? Or is there maybe an element of irrational exuberance playing into this surge, especially given the market's broader tug-of-war?
That's a critically important question. What's fascinating here is the strong narrative supporting the crypto rally, but also, the need for a balanced perspective. Bitcoin climbed to a new cycle high of $124,002. That's a 1.6% jump. And Ether also reached a new cycle high of $4,780, up 1.7%. The primary fuel behind this exuberance is indeed the increasing expectations for U.S. interest rate cuts in the near future. Lower rates make traditional savings less attractive and, push investors toward riskier, higher growth assets like cryptocurrencies. Beyond that, we're seeing sustained institutional inflows into the crypto space. That adds a layer of legitimacy and demand, differentiating this rally from earlier, more retail-driven surges. And crucially, there's been significant progress on the regulatory front. This includes movement on stablecoin legislation, which aims to bring more stability and oversight to digital currencies pegged to traditional assets, and even a presidential order that could potentially allow crypto assets in 401k retirement plans. These developments signal a more favorable, maybe clearer operating environment for digital assets, reducing some of that previous regulatory uncertainty. However, this raises an important question. How do we truly balance excitement with risk? While the momentum is strong and the narrative compelling, the asset class remains highly volatile. Investors should be reminded of the potential for sharp, rapid reversals if policy expectations shift unexpectedly, or if there are any unforeseen regulatory or tech setbacks. It's a dynamic space, but one that still demands careful risk management, especially for individual investors.
That's a crucial distinction, and one that many might overlook in the rush of record highs. It reminds us that even with positive tailwinds, the inherent volatility of crypto hasn't just disappeared. If tailored intelligence aligned to your exact priorities matters to you, Nextsite delivers. Their platform supports investigators, analysts, and decision-makers worldwide with deep, actionable intelligence. They cut through the noise to give you the signal you need for informed decisions. Now, as we integrate all these threads, the inflation signals, the equity divergences, the credit tightening, the commodity shifts, and crypto's new highs, what does this all mean for you as you look forward? And what should you be watching as we move into the weekend and beyond? Let's turn our attention to the forward-looking insights from the brief's trend and risk map.
Well, the trend and risk map lays out several key themes that connect everything we've discussed, sort of painting a picture of the macro environment. First, there's that continued soft landing narrative versus sticky inflation. While U.S. equities have rallied despite that hot PPI, there's a real risk that persistent inflation could force the Fed to keep rates higher for longer, potentially risking a broader growth slowdown. For you, this might mean maintaining a balanced portfolio between cyclical sectors, which thrive in growth, and more defensive sectors, which hold up better in slowdowns.
Makes sense.
Then we have the European rotation we mentioned, with investors shifting into insurers and defense stocks, driven by solid earnings and those geopolitical tensions. This suggests a potential overweight in European financials and defense, maybe an underweight in more discretionary consumer names. It indicates a strategic shift in investor focus towards perceived safety and stability in that region. Regarding crypto exuberance, well, Bitcoin and Ether hitting records on rate cut hopes is exciting, but the volatility remains high. Any shift in policy expectations, a major security vulnerability, or even a sudden regulatory hurdle could trigger sharp corrections. For investors, this really implies using disciplined position sizing. Not allocating too much of your portfolio, and maybe considering tools like options to capture upside without overexposure to sudden drawdowns. The oil price rebound, fueled by that geopolitical optimism around a potential Trump-Putin meeting, also carries risks. Global demand remains somewhat fragile, and U.S. supply could increase quickly if prices stay high, potentially capping further gains. So we need to monitor this closely for its impact on energy costs. We also see a clear bond yield divergence. U.S. yields fell while European yields rose. This reflects market expectations that the Fed might cut rates sooner than the European Central Bank. This creates opportunities for relative value trades, like going long U.S. Treasuries against short German bonds, basically betting on that divergence continuing. Finally, the housing market stabilization is a positive sign. Mortgage rates hitting a 10-month low 30-year, fixed at 6.58%, 15-year at 5.71%. That's spurring purchase applications. However, affordability remains stretched for many, and a potential economic downturn could still hit demand. This is a space where certain segments, maybe like home builders and mortgage lenders, might outperform if rates keep drifting lower, but it requires careful watching.
That's a comprehensive overview of the macro landscape. And to bring it down to the most practical level for our listeners, what should be on everyone's catalyst calendar and operational watch items for the coming days? Which events should you be marking as essential?
Absolutely. Looking at the catalyst calendar, for the rest of today, Friday, August 15th, we have U.S. industrial production data, which will give us a read on manufacturing momentum, and the final University of Michigan consumer sentiment report. A further drop there could definitely weigh on retail stocks. Next week, Tuesday, August 19th, we're watching U.S. housing starts and building permits. Key indicator for the housing recovery, signaling new construction. And that same day, Home Depot's Q2 earnings call. That's a major bellwether for consumer spending, given its broad reach into home improvement.
Big one.
Definitely. On Wednesday, the 20th, the FOMC minutes from the July 30th meeting will be released. That'll offer deeper insight into the Fed's thinking on rates, the future path of policy. We'll also get the EIA Weekly Petroleum Status Report, which can directly impact oil and gas prices. Then, Thursday the 21st, we'll see the latest U.S. initial jobless claims data, signaling whether the labor market continues to cool, and the Euro area flash PMI, an early gauge of economic activity that could pressure the Euro or European equities. From an operational watch items perspective, it's crucial to monitor cross-asset volatility despite those low VIX levels, as sticky inflation could still cause sudden market spikes. There are also clear opportunities in rate-sensitive positioning due to that yield divergence between the U.S. and Europe. Think about those long U.S. Treasuries versus short German bond strategies. For crypto, disciplined position sizing and stop losses are key due to the potential for rapid drawdowns, as we discussed. Keep a very close eye on commodity supply dynamics, especially next week's EIA report and weather forecasts for natural gas, as these can quickly impact energy prices. And finally, just be aware of regional holiday impacts, particularly when Indian markets reopen on Monday, August 18th, and any geopolitical news like that potential Trump-Putin meeting, which could rapidly alter energy and defense sector dynamics.
That truly was a deep dive into the Thursday, August 14, 2025 intelligence brief delivered to you on this Friday, August 15th edition. Don't forget to follow us on YouTube and Spotify, and like, share, or comment. We'd love to hear your take. Have a productive Friday and an even better weekend ahead. And as you reflect on everything we've discussed, the global market's current tug-of-war between soft landing optimism and persistent inflation, what segment of the global market do you think is best positioned for the rest of 2025, and why? We'd love to hear your thoughts.